Right. Here they come. Good afternoon, everyone. Feel free to unmute yourself to say hello.
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 Hi.
I'm always curious to see people's backgrounds. Oh. Cash's background is particularly interesting. I have to work out what that is. How you doing, Cash? All right?
Good, John.
Very good.
Hi, everybody.
Hello there.
Hi, Cash.
Hi.
I've just got a couple more in the lobby, so I'm just going to admit those, and then we'll get started. Okay, so welcome everyone to the Haslers Autumn Budget. So this is a live Q&A hosted by Haslers Chairman and Senior Tax Partner, John O'Shea. Before I pass you over to John, just a bit of housekeeping. This is meant to be a very informal Q&A, so if you do have any questions, please feel free to either raise your virtual hand using the icon or post in the messages. We're also happy if you do want to unmute yourself, then feel free to unmute to ask the question. But to keep noise interference to a minimum, I would ask that if you could all kindly keep yourself muted throughout unless you're speaking. So just to let you know, we'll be recording this and we'll be able to send you a link of the video after it's taken place.
No,
so
bye, Charlotte, I promise you.
So now that's all sorted, I'll pass you over to John, and we hope you find it useful.
Yeah, that will be a challenge, I think. It's I've worked in tax for 35 years now. One of the things I always tell our trainees when they come in for interview is the graduates or school leavers that come in, they don't really know anything about tax. And I sell them this exciting phenomenon that we have in tax every year called Budget Day. Where legislation that's been on the books for 20 odd years suddenly gets cut in an instant, or new things get invented and the whole landscape changes on a regular basis. And I tell them it's the most exciting day of the year. Well, I'm going to have to change that spat that I give out in the interviews now, but I have to say in 35 years I've never come across a budget that has so little content ever before, and I'll be amazed if there is one like this again. It was less of a budget and more of a party political broadcast, not for the Tory party, but for the Rishi Sunak party, who congratulated himself for pretty much everything positive and blamed global factors for everything that was negative, which seems to be his style. But he started off apologising to Madam Deputy Speaker for all the leaks that there had been in the press, and I thought, well, it's a bit strange he's come out with that at the beginning. He must have something hidden away in the speech somewhere. But in actual fact, he really didn't. There was virtually no new tax issues at all. So it's going to be a fairly quick run through, and I'll mention at the end a couple of the changes that are coming up in the next couple of years that weren't really part of the budget at all, but just as a reminder. And I think we're going to be going to Q&As fairly quickly on any subject you like, because there really aren't too many things you can ask about this budget. Anyway, let me give you the flavour of what he spoke about. It was a very triumphant opening from him, and he was very much playing up to the cameras and started off using this phrase, levelling up. There was some suggestion that some of the Tory MPs were maybe playing Northern City bingo, because you've got Northern Cities mentioned in it so many times that there clearly was something going on there. He starts off saying growth was up, jobs was up, and debt was down. Now, that on its own is a bit of a statement, because the last time I looked at current government debt, it currently stands at £2.6 trillion. And for those of you who want to write that down, it's 13 digits, £2.6 trillion. And at no point ever other than 1 year, in I think it's 2001, has it ever gone down. So to say it's gone down is a little bit of a stretch, but I'll explain how he managed to pull that one off. But 2.6 trillion, just to put it in perspective, for every man, woman and child in the country, government debt is about £40,000. For every taxpayer in the country, it's actually about £70,000. So it's a pretty phenomenal figure. So how has he claimed that government debt, which is now 2.6 trillion, is coming down? And the answer is a bit of clever mathematics. By using it as a percentage of our GDP, he can just about claim that government debt will be falling over the next couple of years as inflation effectively erodes the amount of government debt. Obviously, it is coming down, and the forecasts that they had for the deficit caused by COVID certainly have been overdone. Whether that was deliberately in the past or not, who knows? But I think the expenditure they expected to pay out has turned out to be probably in the order of 100 billion less, which is an absolutely phenomenal figure. And that is why most of the budget really was taken up with these huge announcements that he's spending money left, right and centre, levelling up the country, all these promises to all of the government departments with expenditure going up in every single government department. And the answer is because he's overtaxed us over the last year or so in anticipation of a much higher budget deficit. That's why there's no further tax increases in this budget. It's probably a good thing. Each year you get the rumour about what's going to happen, and the old favourites normally come out. They're going to hit, higher rate relief on pensions. They're never going to do that. They were definitely going to increase capital gains tax this time. I always thought it was unlikely. We know that they issued a consultative paper in November last year, and that does talk about aligning the rates with income tax rates, but it's just a lot more complex than that. But typically, from consultation paper to getting things on the statute book can take anywhere between 2 and 4 years. So to get it done for a budget within, inside 12 months would have been a stretch, I think, at best. So I think it's unlikely. Generally speaking, politically, tax increases come at the beginning of a parliamentary period, not towards the end of it. And he did make that absolutely crystal clear in some of his comments that he still believes in lower taxes, and before the end of this parliament, he does see those coming down. So that'll be interesting to see as and when that actually happens. But the key points in terms of the economy that he came up with, inflation, which is currently just over 3%, he very cleverly worded would rise to maybe a 4% average over the next year. The fact that he used the phrase 4% average would suggest that the figure is actually going much higher than that at some point in time, and the rumour is it could hit as high as 5%. That, of course, is not his fault at all. Anything that's negative is due with global factors, and he managed to get that phrase in every time there was something negative. And he spoke about the COVID close down and reopening and demand outstripping supply chains and global energy demand. So anything that was negative, that's a global problem. Anything that was good, that was down to Brexit, it would seem, if you believe him. In terms of growth in this country, the OBR forecast now up from 4% to 6.5% for the current year and to 6% for 22, and then returning to more normal rates of growth from 23 onwards. Unemployment forecast, which originally apparently was scheduled to hit perhaps as high as 12%, they now think peaks at only 5.2%, which is, I think, a large part of the explanation as to why the budget deficit is not as high as they were originally predicting. It's a difference of about 2 million people in employment, which is obviously a staggering difference in terms of tax revenue and obviously benefits paid out as well. And they forecast down what they call the COVID scarring measure, which is a new phrase they come up with. What is the permanent effect of COVID on the economy, which originally was considered to be about a 3% drop, has now been revised down to a 2% drop. So that's obviously all positive stuff. In terms of actual changes, he made some mention, which I think is just, again, playing to the audience about the HGV levy being suspended until 2023. We do have one client in that industry that may well help, but it's not going to suddenly get a mad rush of people, I don't think, into the industry, but is welcome nonetheless. The 0.7% that we used to give in overseas aid every year, which was cut back slightly during the COVID period, will apparently now return to the 0.7% by 24-25. One new tax, which, I mean, it wasn't new in this budget, had previously been announced, but a bit more detail, again, isn't going to affect most of our client base, I wouldn't have thought, but there is a new residential property developer tax being introduced, but it is only for profits over 25 million in an accounting year, and that's been set at a rate of 4%. The idea, obviously, is just to take a bit of extra money out of the large house builders in the country that have actually done surprisingly well over the last couple of years, despite the COVID environment. Then he moved on to research and development, and this, I was having a little chuckle. He was congratulating himself on what he had done here, and he was comparing the figures, research and development in this country, to most other sort of G7 and G20 nations, and he claimed that R&D expenditure in this country had risen from roughly 0.7% of business investment to 1.1% because of the fantastic R&D reliefs that they had introduced over the last couple of years, which compared very well and favourably compared to the other G7 countries. I think the point he's missing is that I don't think there's actually been any change in R&D expenditure by any companies in the country. What they have got better at is claiming it. And there have been a huge amount of R&D claims by many companies, private companies, over the last couple of years on what you might regard as fairly normal expenditure, but one that we can now get to fit the criteria. And claiming that is an increase in R&D expenditure in this country is, I think, perhaps a bit misleading. There was a couple of minor changes to factors that could be included in future claims, mainly centered around the costs of data centers and cloud computing, which previously had some issues in R&D. And the other major factor in R&D is, although he claimed it as a good thing, was effectively cutting out any expenditure outside of the UK. Detail on that to come. That's from April 23. But I thought that was a little bit misleading what he said there. Sorry, so there's a question there. Nope. You can tell how boring a budget is when they start talking about shipping tonnage tax. I've absolutely no idea what it is, if I'm honest. I've done a little Google since then. I've still no idea what it is really, but it's something to do with ships moving around and the type of flag that you have on it. And because we're now out of the EU, apparently you can get the red ensign, which I also had to Google because I have no idea what that is as well. But apparently it's kind of like a New Zealand flag. It's a red background, and if you stick that on your boat, that makes you a British ship. It's called the red ensign, and that will enable you to pay less shipping tonnage tax, which will be of great solace to all of our clients, no doubt. Air passenger duty, again, the fact that it's in the budget being spoken about suggests that there wasn't a lot of content really. The bottom line there, they're cutting in half the rates for air passenger duty within the UK, and from a later date, it didn't say when, there will be a higher rate for long haul journeys. This is all under the green environmental policy, but it's of course just balancing the books for the cut in the UK one. So flights over 5,000 miles, which is slightly concerning because I think Vegas is 5,000 miles away, isn't it? Will pay a higher rate, presumably to make up for the lower domestic rates. Then very briefly, for a moment, he actually mentioned tax. And he mentioned about the corporate tax rate, which, again, there's no change to it because he's already announced previously that corporation tax is going up to 25% from April 23. And he made reference to the fact yet again It's still the lowest corporation tax rate in the G7. I think he also said something like the fourth lowest still in the G20. And then there was an actual change in tax legislation. Steady yourselves for this exciting news. At the same time, he introduced the super deduction for capital allowances, which I'm sure you're all familiar with, which runs all the way through to March 23 and gives you 130% as a multiplier effectively on any expenditure on new plant and machinery from last budget day. But there was also the annual investment allowance, which applies on any plant and machinery, so it doesn't necessarily have to be new, it could be second-hand plant, and also applies to non-corporates as well. That was due to expire at the end of December 21. He's now confirmed it will stay at that rate until March 23. So that aligns with bringing it through to the new change in rates as well. Then there was quite a bit about business rates. The bottom line of business rates was apparently it's a good thing to have revaluations every 3 years. Obviously, it's going to depend on what side of the fence you sit on there. That will be good for some people. That will not be good for some people. They introduced a new temporary relief for improvements to properties that will not affect your rating bill until 12 months after they've been complete. Have to be honest and say I think that's what most people do anyway, but now it is in legislation. People don't normally rush back to their local councils to say, I've massively increased the size of my property, can I have a higher rates bill please? But that at least confirms now there is a 12-month window there, and there'll be some form of green relief introduced for people that have things like solar panels, etc., on their buildings, but no real detail on that as yet. The normal inflationary multiplier for next year is abolished, which is obviously good news because inflation is probably going to be about 5%, I should think. And probably the most interesting point from the point of view of the rates bill is a 50% discount for retail and leisure industries up to a value of 110,000. Wasn't absolutely clear whether that was per property or per business, but whichever way you look at it, that's a pretty significant discount. And will help those industries that are obviously still struggling with COVID stuff. And then there was the alcohol duty, and this took up about 10 minutes of the speech, believe it or not. And he even gave a little history lesson that the alcohol duty was first introduced in 1643 to fund the Civil War, which is something I didn't know actually, so I learned something in the budget at least. And he's essentially cutting the multiple rates to what he said was an easier to understand rate, which is basically based on the strength of the drink, and the higher alcohol content, the more alcohol duty there will be. And there was a little sort of tip or nod and tip to Essex by pointing out that Prosecco will pretty much halve the alcohol duty. So there will be celebrations up and down Westfield, no doubt, later on. And in order, I was going to laugh as they come up with these things. They must say these things out loud first before they say them. But apparently, to help underlined people with drinking problems, which apparently mostly occurs at home. They're cutting the duties in pubs so that alcoholics can go to the pubs with the other alcoholics, and I don't know, maybe it's self-therapy or something like that. At least we'll know where they are now, I guess. So yeah, it will be cheaper to drink in a pub than it would be to drink at home or go and buy your booze from the supermarket, I guess. And apparently all of that, those alcohol duties, it's a £3 billion cut. And it's how much alcohol do we actually drink in this country? Quite a lot from the sounds of it. Fuel duty rise cancelled, probably very wise, considering what's happened the last couple of months on fuel and petrol stations, etc. And then he announced what he's already announced at least 3 times before: the national living wage is going up from £8.91 to £9.50. And that is, as they say, on track to get to their target, which I think is probably around £10 an hour within this Parliament, I think. And just as a reminder, there is this phrase minimum wage and this national living wage. The difference is very much an age-based thing. So national living wage applies to those who are 23 or older. The national minimum wage applies below that age, unless you're an apprentice, in which case there's an apprentice one as well, unless you're an apprentice that's over 19, in which case you're back to the national minimum wage, unless, of course, you're over 23 in the first place. Good. All very clear. He did point out also that high taxes were absolutely not his fault at all during the budget, which was a pretty bold statement from the person who's responsible for setting taxes in the country. But that is what he said. And he did say that future taxes will come down by the end of this parliament. Probably, I don't know, just around the time they're going to call the general election, say, says the cynic in me. And then his big ending, which normally in a budget you get something dramatic at the end, but again, pretty much had all been announced in advance, and he really built himself up to this. Was all to do with the universal credit taper rate, which it had been leaked before would be cut from 63% to 60%, and he blew everyone away by saying not 1% cut, not 2% cut, but 8% cut, and everyone went mad and cheered. And it's obviously not going to affect a huge amount of people because it only applies to universal credit people who are actually in work as opposed to out of work, just to make that absolutely clear. So that was literally the entire budget. There was one notable change, which was the AIA, and that is about it. But a couple of things which I think are worth mentioning and reminding people of are changes that are coming up in the next couple of years. Obviously, we've got a significant change in the corporation tax rates coming in April 23. And just to remind people how that works, the rate at the moment is 19%. It goes up to 25% from April 23. There is a transitional rate. You know, if you're below that level, still 19%, and there is a marginal rate between 50,000 and the 250,000 limit, which is actually 26.5%, and that depends on how many companies you have. Some of you may remember, this is going back probably 10 years or so ago, when we used to have the variable rates, that marginal rates were dictated not just on the profits, but the number of companies that you controlled, either as an individual or as a group as individuals. All that legislation was abolished some 10 years ago, and now it's all coming back in, and it is a different measure, helpfully, to working out whether or not you are eligible for the quarterly payments of corporation tax. That's based on the number of companies within a group. The associated companies rule is the number of companies in which you control, which could actually be a different number, which would be interesting. So it's just something for people to bear in mind, to review their structures at the moment. What might have been the right thing to do over the last couple of years may not be the right thing to do from April 23. If you've got more than one company, it is worth reviewing that situation, or at least having a discussion with us on that. So that's the corporation tax rate. It's a significant change. Don't forget also, from next year we have a new tax, only they don't call it a tax because that would have breached the manifesto requirements. Everyone calls it the health and social care tax. It's actually called the health and social care levy, which is 1.25%. That comes in from April 22. But for the first year is linked to national insurance. So it's paid by both the employee and the employer. But also, and I think a lot of people have forgotten this, it also adds on to the dividend tax rates as well. So they're pretty much getting all forms of extraction from private companies covered by this tax. From 23, it will fall out of national insurance and become a separate health and social care levy, not tax, levy. And it will therefore apply to anyone of any age, whereas at the moment for the year 22-23, because it's linked to national insurance, it's possible that those over the normal age, retirement age for national insurance from the employee angle could escape, but they will not escape it from 23-24 onwards. That's just something to remember. The other significant change coming up next couple of years, well, two really. One is for self-employed and partnerships. There is a significant change to the manner in which you're going to be taxed from 24-25 onwards, whereas at the moment everyone is taxed in the tax year on the accounting year that falls or ends in that tax year. That will now change to effectively an apportionment basis within the tax year. So as an example, if you had a year end of 30th September and you were doing your tax return for 2021, you would take the accounts to September 20. That's the one that falls and ends in that tax year, and that's what you tax. On the new basis, if you didn't change your accounting year, and we'll come back to that in a moment, then you would take 6 months of your 20 accounting period and 6 months of your 21 accounting period, and that would form the basis of taxation under the new basis. It's like everything in tax goes around in circles. That used to be the rules about 30 odd years ago, and we're effectively going back to that. We did consider whether there should be a rush to everyone changing the year ends to March. But in actual fact, they've sneaked in a bit of legislation, some positive. Because of the change, there will be a transitional year in 23-24, which effectively forces, if you've got any accounting period other than March, you'll end up with more months profit than there are months in a year taxed in one particular year. So taking that example again, if you were the September year end, you would end up with 18 months taxed in that transitional year because it's got to catch up. That might be increasing your liability significantly, and the increase element, i.e. the 6 months additional, should be spread over a 5-year period is what we understand from the draft legislation at the moment anyway. So there's a lot to think about in terms of those in self-employed or partnerships over the next couple of years as to structuring what to do with the accounting year. That's for sure. At the same time, making tax digital will be introduced, definitely, they say, this time. Albeit they also said that 2019, 2020, 21, 22 and 23. But now it's definitely going to be introduced in 24, 25. And just a reminder, that's everyone who's self-employed, in partnership, or a private landlord of some sort with profits over 10,000 will be required to make a quarterly return to the Inland Revenue. It's not a tax return, I make that absolutely clear. Just merely a statement of income, and that has to be done on a quarterly basis. Why? It's a great question, actually. The revenue say, this is what they say, I wrote down the quote because it makes me laugh. The digital tax system will be more efficient, make it easier for customers, that's you guys, to get tax right and bring wider benefits in increased productivity. There we go. Just by doing your books on time and sending your information to the revenue every 3 months, as opposed to every year, apparently is going to increase your productivity, which is a real bonus for everyone. The reality, of course, is they want people to have their accounts, if you like, coterminous with the real world, so that when you do adjustments at the year end, you do the accounts, etc., that it is much more difficult for people to go back and make what you might call retrospective adjustments, because you have already disclosed figures to the revenue. So sort of year-end adjustments that are fairly typical will stand out massively to the revenue. Why are they doing that? Because they want to raise inquiries on those cases. It's really as simple as that. But there we go. It's the budget that wasn't really a budget, I'm afraid. But that does sum it up. At least there was no new taxes, I suppose. But there was nothing really in terms of giveaway either, to be perfectly honest. So if you've got any questions on the budget, which is unlikely, or anything else, at least tax related, then we're very happy to take questions. But I'm afraid the content just wasn't there for us today.
I think just quickly, while we're waiting to see if anyone has any questions, I have popped in the group chat, obviously based on your comments, John, about the corporation tax increasing.
Yeah.
We're hosting a webinar on this next February, which does sort of feel like it's a long time away, but we'll blink and we'll be there. So I have popped a link in the group chat. If this is of interest to anyone, feel free to register. And obviously we'll do a follow-up email after this anyway, and I'll pop a link on there. So yeah, if that's of interest, feel free to register for that. So does anyone else have any questions other than Pamela confirming in the chat that Vegas is 5,217 miles from London?
I know bad news. Cash.
I think that's it. So no questions. So I'm going to stop